so that's the problem, is that it's only getting worse, right? So you have the interest payments going up, and then the Treasury they announced that they're going to borrow $350 billion more, okay, this next quarter than they expected to. Right. So, I mean, and why? They actually put out a statement that basically said it's because of lower tax receipts and higher spending. And so they had a cost of living adjustment on the entitlements on Social Security. And then, so if you look at it, we're going to run a deficit of over $2 trillion. Okay. So, but it's exacerbated now. And this is kind of just my first take on it. Before everything happened this weekend with the banking crisis, right? So now you've got these banks who are trying to shore up their own treasuries and make sure that they're well above capital requirements and liquidity requirements. And so what does that mean? That means they're going to be a little bit slower to lend out their capital. And they're going to be it's just going to tighten the belt on the availability of capital to small businesses and people, and individuals. And so that again is going to decrease productivity and then decrease income, which decreases your tax base. And it's obvious, and that's going to happen, right? And it's starting to happen right now. We just don't know how tight it's going to get. And then you've got the Fed coming out next week, and all the way up until last Friday, the momentum had been for the expectation. It was for the Fed to raise by 50 basis points, but with this liquidity crisis, with a banking crisis, right? People worried about getting their money out. They're worried about whether it's actually insured and how much is insured, and are there deposits? Are they in danger of being seized? And what's amazing about this is I didn't, I'm not going to say that I foresaw this exact event happening, but looking at the Credit Suisse situation, I started getting, questions about, hey, what happens if Credit Suisse does go bankrupt? What happens to all those deposits? And it's actually been laid out through the Dodd-Frank legislation, and then the ECB did this as well, where and actually the test cases with Cyprus, where they seized bank accounts in order to pay off the creditors of these banks when they were going under back in 20.
Speaking of Cyprus, it's 2013, and what's funny for me is this brings it back, because this is 10 years ago. That was actually the narrative for a Bitcoin pump. About 10 years ago as we speak, right? So Bitcoin was pumping. It was something like, it started the year 2013, I want to say in the teens. It was like $15, $20, in that range.
Right.
One Bitcoin, right?
Crazy.
And over this next few months, there was a Cyprus bail-in. And there was a massive run. And now, whether or not it was actually Cypriots going and buying Bitcoin, that's probably not really what's happened, but maybe it was the narrative. And so Bitcoin pumped to $260 and then crashed to, I think, like $50, right? And this is all happening 10 years ago around this time.
This is the interesting thing. So you're seeing Bitcoin kind of decouple here now. As much as I wish it were, because it was actually decoupling, because it's harder money. It can't be manipulated. It's decentralized. It can't be seized. All of that, they're really strong, important aspects of Bitcoin, and I wish that were the reality of what's going on here. But this goes back to Friday, when everybody realized, the Fed is going to have to either stop raising rates or lower rates here, and so Bitcoin, it's been the tip of the risk on assets spear for a while now, and so Bitcoin sniffs this out and just takes off before every other asset. Part of that is because, it trades 24/7. And over the weekend, people realize, oh my God, the Fed may have to stop here. They may have to pivot. Well, what does that mean? That means that they'll loosen up the capital, and the restraints on risk on assets. So people would buy stocks, they buy tech stocks, they buy Bitcoin, and they buy gold and silver. So it took off. But then as people realize, well, the numbers that are coming in still, the economic numbers that are coming in still are strong enough that it doesn't really give the Fed the ability to stop raising rates here or lower them right now, because the Fed and the Treasury did bail out the banks
that were in trouble,
and so they did shore up the depositors, and so they kind of quelled that crisis. And so now you've got the Fed in a terrible position. I mean, they've put themselves in a position and they've been in a terrible position, but now you've got the Fed still trying to fight inflation, which is being caused by, it's still a supply side issue, quite a bit of it, from what I can tell. And they're trying to fight it by raising rates, and they're raising rates on a levered system. The system is so levered that cracks are showing and things are breaking. And so, quite honestly, what happened was that bank broke. Yeah, there were things overlooked. They could have done better. They could have had interest rate hedges. And so for your listeners,
we should just kind of go through a little bit of an overview of a little bit of what happened there. And it is relevant to Bitcoin as well. So I guess there were probably three banks that we're talking about here. There was Silvergate, who were, I think now their case is maybe a little bit different because I think they sort of got into trouble and they voluntarily said, hey, we're going to shut down, pay everybody back. The next one is Silicon Valley Bank, which is obviously big in the tech VC world. A lot of small companies and startups have their accounts with Silicon Valley Bank. And, as I understand, they essentially had this interest rate risk problem, that they had a lot of these
We'll talk about
Yeah, let's get into that. And then I guess the other big one was Signature, which also got shut down. So do you want to just give us your kind of high level explanation of what went down, especially, we should start with Silicon Valley Bank. Yeah.
Well, yeah, I mean, it's still, we know what happened in Silvergate, but in Silicon Valley, what happened was, so to super simplify it for everybody, a bank takes in deposits from customers, and they could be individuals, and they could be corporations, companies. And Silicon Valley, no surprise, has massive accounts from venture capital firms and from entrepreneurial startups, tech startups, right? So small companies. So they have all these corporate accounts, not individuals. So already right there, that puts them at risk, because each account can take out so much money if they need that capital, right? So, individual accounts and personal accounts are much stickier typically, right? All right. So what happens? Well, they get these deposits and then they loan out 85 to 90% of those deposits. They loan them back out to other customers, right? So they get the money in, they put some aside, and then they loan the rest out. Well, the amount that they put aside to put in their own treasury, right, to put in their reserves, well, they have to do something with it. So what did they do? Well, the managers, the investment managers at the bank, they were watching the Fed and had decided, well, the Fed is telling us that inflation is just transitory. It's going to be over soon. The rates, if you look back, Stephan, if you look back in December of 2021, okay, the Fed governors, they do their dot plot, right? They plot out where they think interest rates are going to be. The average, I'm not going to put you on the spot here, but the average dot plot, the average, governor and Fed official thought that in a year from then, right? So the end of December 2022, they thought the interest rates on average were going to be at 0.86%. So they were off by about 4%, which is absolutely unbelievable. I mean, it's just, it's 4-5 times what. So they raised rates, like Powell put rates on a rocket ship, right? Just raised them straight up. And so banks were caught flat-footed. The ones who believed them bought these longer dated treasuries with that capital and put it in their reserves. So they've got these longer dated treasuries expecting, well, rates are not going to go up that much. So we don't have risk because they're risk-free bonds, right? Well, no, you have interest rate risk. And what does that mean? That means if you hold that bond to maturity, yeah, it's near risk-free. Why? Because the United States government is going to print enough money to pay off your debt. You're going to get your dollars back, right? That's a 99.9999% probability, right? So, but if you need that capital before that debt matures, you have to sell it in the open market. Well, what happens in the open market to debt? There's an inverse relationship between price and yield, right? So if a bond is yielding 4%, it's going to be priced lower than a bond that's yielding 1%, right? Because to make 1% on the capital that you give somebody, you don't have to make up so much capital. So the bond goes down in price as the yield goes up. It's just that inverse relationship. Okay. So what do we know happened? Well, they bought these bonds, long-term bonds, like we're talking 5 years, 7 year, 10 year, 15 year, whatever they are, and they're mix of bonds. And so they're obviously, they can't hold them to maturity if somebody wants their money back. All right. So they go into the market to sell those. Well, now those bonds that they bought that were yielding 0.5%, 1% are now a similar bond in the market is yielding 4 or 5%. Well, how are if they go to sell those, nobody's going to buy their bond at the price they bought them at. They want a 4 or 5% yield. So what does that mean? That means the price of the bond goes down. So they take a loss, a massive loss. And if you, it's called duration risk. If you plot that out 7, 10, 15 years, that the movement on those bonds is enormous. It's 20, 30, 40%, depending on the bond, So, they got absolutely annihilated when people wanted their money back. They had to sell what they had in their treasury to meet those calls. And then it ended up being that they were selling so many at such a large loss that it became clear that as people were getting more and more worried, as companies were getting more and more worried about this, and they were all drawing out their capital, this is called a run on the bank, and their asset and liabilities were mismatched, they went under. They just couldn't meet the call. And so the FDIC, the feds had to come in and seize the bank and take over. And that's what happened.